Hey, what's up guys? John here, the second most successful home builder in America, Lennar. They built 53,000 properties in 2023, over $20 billion in overall revenue. They're looking to liquidate an 11,000 unit portfolio for $4.5 billion because of how bad the multifamily housing market has gotten. They're looking to sell at the top before everything comes crashing down. When you look at what's happening across the big operators versus what's happening even to the median-sized operator, they're all walking into a wave of problems refinancing at these much higher interest rates. Rising insurance and taxes becoming a very big problem.
More and more homeowners are abandoning home insurance because of skyrocketing costs.
Rents are softening. It's a big change that's coming.
Rent prices are on the verge of going negative.
Apartment rents have been cooling off sharply for several months now.
That I believe is going to result in many landlords losing everything and many new investors stepping in and making an absolute fortune. When you look at the numbers and how much money they're losing, you'll see very clearly what's going to happen next. And I'm going to break it down for you and show you the facts. Please hit the like button. Hit the like button. YouTube will share this content to educate more people about what's happening in the residential and multifamily housing market. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item under credit report, go to GreatCreditFast.com, click the link in the description just below this video, schedule a free strategy session. Take a look at this. So, the number one home builder is D.R. Horton. Number two is Lennar. Now, Lennar's 53,376 homes completed, right? Home closings, and $20.8 billion in revenue for 2023. So they are a major contender. But when you look at what's happening to their multifamily revenue, it's at $141 million in Q4 2023 with an operating loss of $12 million, reflecting a decline from $179 million in the same quarter the previous year. Now why? What's happening? Well, everything is changing for them. The borrowing costs are getting through the roof. When you are a big home builder, you're not borrowing money for 30 years at a fixed rate. Every couple of years, you have to refinance that debt. And when you go from an environment of 3%, 4% interest rates, now refinancing at 7, 7.5%, 8%, it is a major blow, right? And they're looking to try to pull some risk off the table here because they know for a fact that a lot of opportunity is going to be coming. And a lot of people are going to be in distress, and them sitting on so much dry powder is going to enable them to go out there and become a lot bigger by buying up all this distressed property. So, but the numbers are astounding. The numbers are absolutely astounding because they're looking for $409,000 for every single unit. For every single unit, $400,000 a unit. Now, for context, if you were to buy this property, hypothetically, $4.5 billion deal, you would need to put down 30% roughly. Right, so $1.35 billion as a down payment. Every unit, let's say, rented for $2,500, and you never had a vacancy. At $2,500 a month, that's $27,500,000 every single month in cash collected. Now, on a 12-month basis, that'd be $330 million, right? With operating expenses of 30% and a vacancy rate of 5%, which is very low in today's market, you're looking at a 4.877% return. Right, a cap rate of 4.8%. You could buy a 2-year treasury at 4.44% with no risk, basically no risk. Or you could buy this deal and you have to build out a massive team, management, dealing with evictions, dealing with all this headache problems, and the market's going to continue to change. Why would you do that? You wouldn't. No one really would. Even if you're a large operator, you wouldn't look to this. But when you start to see what other operators are going through right now, you'll see some very interesting trends. So there's another operator that bought a student housing project in Gainesville, right? The student housing project, I mean, what they did is it was 50,000 students, right, come to this school every year. Overall, student housing has performed strongly, Moody's said, and this particular housing project had done so as well. Net operating income for the first half of 2023 has the property on track for a year-over-year increase of nearly 50%. So they increased the income of the building, of the asset, 50%. But despite the strong increase, the property is also a large loan that has resulted in debt yield of 8%. While that would have been more than enough to secure refinancing 2 years ago, it falls in a more questionable range in today's market. The loan appears to have been granted a 60-day extension, so we'll keep an eye on it to see what happens. Moody's said that the picture is less concerning than originally thought. With 2 projects responsible for half of the multi-maturity defaults, it still demands caution. It might be that slowing rent and growing interest rates and costs are catching up with the potential for greater problems down the road. Now, if someone bought a property a couple years ago, they increased the cash flow 50% and they are in the red zone, you have to wonder, what about everybody else that bought 4% return deals, 5% return deals, stabilized deals? These people are in huge trouble. They're in massive, massive trouble. I mean, look at this short seller. This is a famous short seller. His name is Carson Block. He's the founder of Muddy Waters. Revealed he's betting against Blackstone Mortgage Trust on Wednesday in a signal that he expects commercial real estate woes to drag on into next year in a report titled, "Here Comes the Cliff." Block suggested that the publicly traded real estate investment trust, REIT, which provides loans to the ailing commercial real estate sector, faces a perfect macro storm of rising interest rates and office vacancies. Well, they're also heavily exposed to multifamily. But when you look at what's happening with property insurance, I mean, these operators are getting hit from every direction. They cannot catch a break. Insurance is skyrocketing, taxes are skyrocketing, rents are really falling. I mean, look at this. Over the last week, rents expected to drop in several U.S. cities as markets near oversupply. We're at a 50-year high in apartment construction, by the way. U.S. rental market hibernates. Rents continue to decline. 4 days ago, 5 days ago, the tide turns for renters as asking rents post biggest decline, right? I mean, the year Midwest rents used to be lower, right? This is the one positive sign. They used to be lower. However, in fact, the median rent nationwide is slowly declining. I mean, everywhere. Manhattan's year-over-year median rent drops for the first time. So you're starting to see this unique tide change. I mean, you have the 50-year high in construction, sure, but the other really, really big change is the amount of real estate that was purchased over the last couple of years at the height of the market. So many people have negative equity. They can't refinance out of their properties. They can't sell them. They're going to list them for sale. You have this silver tsunami, all these retirees that have all these properties. I mean, you're looking at almost half of all single-family homes owned by people 50 years of age or older. That, you know, they thought they were set for their retirement. They thought everything was tucked away. They had Social Security. Everything was going to be great. Now look at record high inflation and the rising cost of everything. What are they going to do? They're going to sell their property, get some fiat currency, and just sit on it and hope that, you know, they could make it until their final days? Probably not. They're probably going to rent out their homes, right? They're going to try to move in with family and then rent out their primary homes. You're going to see so much inventory hit the market, which is all going to be more weight and pressure on multifamily. The next couple of years, what I believe is going to happen is we're going to see so much opportunity to invest in multifamily deals. We're going to see so much opportunity to invest in residential deals. There's going to be a lot of change happening all across, not just multifamily, but the job market, the labor market, inflation. All of these things are going to come, and it's going to favor those that have cash. It's going to favor those that have great credit. It's going to favor those that have strong income. It's going to favor those that are in a position to be able to go out there and capitalize on these massive opportunities. But when you look at this, I mean, who in their right mind would buy Lennar's project for $409,000 a unit, where at $2,500 a month, all that would cover is debt service. That would just cover debt service, and the investor that purchased the deal would get a 4% return. They would literally have to rent this deal out. Every unit would have to rent out for over $3,000 a month for the investor to see any type of return. Why would someone do that when the national median rent is roughly half and is likely going to continue to go down? It costs 60% more to buy today than it does to rent. All of the weight is going to be pushed onto the landlords. All the weight's going to be pushed onto those that have debt that has to get refinanced in the next couple of years. You're going to see some of the biggest real estate investors walk into a situation where they're going to get liquidated. They're going to get liquidated. But I do believe you're going to see a situation over the next couple of years where you're going to be able to go out there and buy some incredible opportunities. And if you look at how much real estate is held by mom and pop owners, you know, I'm talking the duplexes, the triplexes, the fourplexes. I mean, you're looking at 70% of all deals are held by these mom and pop property owners. They're sitting on these little duplexes all over the country. What are they going to do as the market starts to change and insurance and taxes continue to rise and the cost of living gets worse? They're going to be forced to liquidate. That's what they're going to do. They're going to be forced to sell these properties. So you want to be in a situation where if you are renting right now, you do not want to be a renter in 5 years. I promise you that. You do not want to be a renter in 5 years. The reason for it? We're going to see a monopolization of real estate all throughout the country. You're going to see large tech companies, you're going to see large conglomerates looking at this mountain of cash they're sitting on, saying, you know what? Every single year, I'm losing more and more and more purchasing power. I'm going to go out there and buy infrastructure. I'm going to buy real estate. I'm going to buy land. I'm going to buy hard assets, and that's what they're going to do. Over the next 4 to 5 years, they're going to run out there buying one trophy asset after the next, one mom and pop property after the next, and they're going to get bigger and bigger and bigger and bigger. And the last thing you want to do is rent from one of these conglomerates, because they're going to try to squeeze every single penny out of you over the lifetime of them owning that property. So position yourself as best you can. Walk into this situation with a really, really strong cash flow position. Have a really strong income, great credit, have cash in the bank, get out of high interest rate consumer credit card debt, understand landlord-tenant laws, study all the changes that are happening in this market. So when you see these opportunities, you can go out there and pounce. You can go out there and invest. What do you think about this situation? Do you think someone's going to go out there and buy Lennar's project, this 11,000 unit, this massive portfolio for $4.5 billion? This is the biggest portfolio in the nation if it trades at this in the last 2 years, right? This is the biggest portfolio the last 2 years from the second biggest home builder in America. You have to ask yourself, do you think that they're making a good decision if they can sell at this price point? Or do you think that maybe, they realize a big crash is likely coming and they want to have a lot of cash and they want to go out there and be able to invest? Drop below. Let's have a conversation. If you'd like to fix your credit to position yourself for this massive real estate wealth transfer, we'd love to help you at my company, GreatCreditFast.com. If you have any credit issues, if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative issue on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow. I'll catch you in the next one.